The definition of the word inflation has changed in modern history. It used to be that the words inflation and deflation referred to the expansion or the contraction of the money supply. But now when you look up the word inflation in the dictionary, it means a hypothetical, extremely brief period of rapid expansion of the universe Wrong one. A continuing rise in the general price level, usually attributed to an increase in the volume of money. Essentially, the rate at which prices go up. Deflation, on the other hand, is going to mean the rate at which prices go down. In my opinion, the best way to visualize this is like a car driving forward at 5 miles per hour. That would be like prices increasing at 5% per year. Now, if you stop that car and threw it in reverse at 5 miles per hour in reverse, that would be the same thing as prices falling 5% per year. But instead of throwing it in reverse, let's say that car is driving forward at 5 miles per hour, then it taps on the brakes and slows down to 4 miles per hour. This is what we would call disinflation. It means, yes, the car is still moving forward, but it's slowing down the pace at which it's moving forward. Yes, the prices are still going up. It's just that the pace at which prices are moving up is slowing down. So now that we have a good grasp of inflation, deflation, disinflation, what is it that we have going on right now? Heck, we still have people saying that right now in America we have hyperinflation. But what is the reality? And more importantly, over what time frame? Because as we'll see, the time frame that we're using to measure these things matters a lot. But most importantly, what is the Federal Reserve going to do about this? Because if the Fed believes that they have won in their fight against inflation, will they finally stop raising rates? So first, let's take a look at the time frames. We have two time frames in which inflation is typically measured. We have month over month and we have year over year. These are going to be expressed by a big M, little o, big M for month over month, and big Y, little o, big Y for year over year. Anytime you see an inflation number being reported and it does not specify year over year or month over month, the default is year over year. For instance, this chart from CNBC reporting the most recent inflation numbers of 3% is a year over year chart, meaning that the prices measured right now are currently 3% higher than they were 1 year ago. In contrast to this, you can also measure inflation month over month. The month over month numbers were 0.2%, meaning that from May of 2023 until June of 2023, the prices that were measured increased by 0.2%. So you understand inflation, deflation, disinflation. You also understand monthly measurements, month over month, and yearly measurements, year over year. Before we move on though, I need to address what I know we're gonna see in the comments section on this video, because this video is primarily descriptive, not prescriptive. So we're looking at CPI numbers. I'm looking at what the Federal Reserve will do based on 3% CPI numbers or 0.3%, 0.2% monthly CPI numbers. I'm just describing the data that's coming out. This is not prescriptive. I'm not saying this should be happening or that this is the right way to measure inflation, anything like that. But if we want to get a good idea of what the Federal Reserve is going to be doing, which impacts markets, impacts asset prices, impacts prices of goods and services, impacts our jobs, our wages, our earnings, our savings, then it might be a good idea to look at the data that the Fed looks at. I'm not saying the CPI is the best measurement of inflation. I don't think it's accurate for your spending, for my spending. I think it should come with a little asterisk, a little disclaimer that says your mileage may vary, but guess what? These are the official numbers, and officials tend to look at official numbers. So it is helpful to see what they are looking at to help us make an educated decision about how to plan for the future. You with me? All right, let's move on. So this was a shock to a lot of people that the CPI came in at 3% for June. Again, all of the things that are being measured and the way that they're being measured by the CPI showed that prices on average moved up 3% from June of last year to June of this year. That was much lower than what people expected. It was the lowest level of inflation since March of 2021. Keep in mind, when the money printing started in 2020, it took almost a year for the inflation numbers, the CPI numbers, to come back to the average of 2%. So the CPI falling to 3% is unexpected and it's a big deal. Since the top, which was in June of 2022, we've had disinflation. Again, prices aren't falling, but every single month we've had readings of lower and lower inflation, meaning that prices are rising at a slower pace than they were before. Now, for anybody who's not new here, you know that I've been talking about how the money supply has one of the biggest influences on prices, and I've been talking about that for a long time. That's why all the money printing that started in 2020 had such a big effect on prices. You can see this massive departure from the previous trend of the money supply growth, and it still hasn't come back down anywhere near that previous trend. Now, most people do acknowledge this, that you print a bunch of money, prices are gonna go up, but those very same people seem to never acknowledge that the money supply has been shrinking for a while now. It topped in April of 2022, and ever since then, the total money supply has been shrinking. If the money supply has been shrinking though, why do we still have inflation? Even though we have disinflation, how come we don't have deflation yet? Well, take a look at the lag effect. The money printing started in 2020, but it wasn't until March of 2021 when the inflation numbers finally got back up to the average that they had been for like a decade prior. So there's a massive lag effect with monetary policy. You print a bunch of money and a year to a year and a half later, it starts to push prices of goods and services up. And then you start to shrink the money supply. Similarly, you're gonna have a year to a year and a half of a lag effect before you see deflation. Now, the money supply shrinking is a direct result of the two monetary policy tools that the Fed uses, which is their balance sheet and interest rates. These both work hand in hand. The Fed's balance sheet is comprised of a bunch of assets that are different forms of debt. Ever since April of 2022, which is when the money supply peaked, the Federal Reserve has allowed some of the debt on its balance sheet to get repaid without rolling it over. Essentially, up until this point, any time debt got repaid, when that debt matured and came due, the Federal Reserve would take those same dollars and loan it right back out into the same kind of a loan. So if the government paid back loans to the Fed would take that same amount of money and re-loan it back out to the United States government. Starting in April 2022, they stopped rolling over 100% of their debt and they started to allow their balance sheet to decline, to shrink. They started allowing some of that debt to get paid off without loaning those dollars back out again. Interest rates going up, with the federal funds rate going from 0% to now over 5%, have the same effect, just not on the balance sheet, but on the balance sheet of banks. Because as debt service costs get more expensive, people decide to pay off more of their debt and not keep as much debt on their books because that debt just gets too expensive. Or if they do decide to keep the same amount of debt or maybe even increase their debt, they still have to devote more of their income to servicing that debt, just to paying off the interest. So both the Federal Reserve's balance sheet shrinking and interest rates going up had the net effect of reducing the total amount of money in supply. And if you don't understand exactly why, it's basically because money is debt. And so every time a loan is made, those dollars come into existence. That is how money printing happens. It is loaned into existence. That means on net, every time debt is paid off, those dollars cease to exist. Those dollars are just no longer in circulation anywhere. They're not in somebody's bank account. Now, here we need to pause again because we looked at the money supply shrinking, we looked at the Fed's balance sheet shrinking, we looked at interest rates going up, and here many people say it's still not enough. We're never going to see inflation go away. The real inflation numbers are just a distraction. Everybody's inflation is way higher than that. And I don't doubt that your inflation numbers are different than the official numbers. But keep in mind that almost everybody who says, hey, it's not enough, the Fed should raise rates more, they should decrease their balance sheet more, the money supply shrinking is not even close to enough, are the same people that say that you should invest in gold and Bitcoin because it has a limited supply. These two things cannot be true at the same time, and I'll prove it. The total supply of US dollars has been shrinking since April of 2022. Not staying the same, it has been shrinking. So if you think gold is sound money because it can only increase its supply at a rate of 1 to 2% per year from mining, and if you think Bitcoin is sound money because of its current inflation rate of 1.5% and its future inflation rate of 0% or being slightly deflationary from lost coins, then you must also agree that the monetary policy of the US dollar shrinking in supply since April 2022 is similarly deflationary. So either sound money can be inflationary because a hard cap on supply is not the only thing you need for stable prices, or the shrinking money supply in US dollars will result in deflation. You can't have it both ways. Just doesn't work. Those are contradictory stances. And I fully admit that both of those stances have solid arguments behind them. But you can't be blasting the Fed for inflationary monetary policy currently with what they're doing with rates, their balance sheet, and the money supply, and at the same time be saying that gold and Bitcoin, or gold or Bitcoin, are sound money. And based on what I know to be true about how the economy works, all the research that I've done over the years, and all the evidence that I've seen to support this, if the money supply of US dollars had become flat in April of 2022, and instead of shrinking from there, we had simply moved sideways, and we still had a money supply of somewhere around the $21 to $22 trillion. In the long term, that would have had the exact same effect as a fully reserved gold standard, or as a fully reserved Bitcoin standard. If you have an inelastic money supply permanently, it actually doesn't matter whether that money supply is dollars or gold or Bitcoin. In fact, that's why people like gold or Bitcoin, because it's harder or maybe impossible to manipulate that, and it makes that limited supply have to happen, versus dollars have the potential to be unlimited. But in reality, if you actually make those dollars permanently limited and never expand or contract that money supply, you would have the same effect. So what is the Federal Reserve going to do as a result of all this? Well, Federal Reserve officials have been very vocal recently, saying that the battle against inflation is not yet over. They've always been very vocal about trying to get inflation back down to their 2% target and have it sustained there, not just touch there briefly. This means that the market is expecting that there will be another interest rate hike of 25 bips at its July meeting. Now, it's still up in the air. The market has not priced in anything that is close to certain yet for another rate hike after that. It's somewhat likely that the Federal Reserve will at least take another break after the July meeting. They raise in July, their next meeting they don't raise, and then looking at the inflation numbers, the market will start to price in the possibility of another rate hike after that. And I think it's actually possible that we do see another rate hike after that. Probably, in my opinion, it's more probable than not. Hat tip to Jim Bianco research, but we saw in August and July of 2022, 0% month over month inflation. So that means from June to July of last year, prices didn't change. And then from July to August of last year, prices didn't change. So for a while, prices had been going up every month, and then last summer, prices moved sideways and then continued going higher, which means that for the next couple of months, it'll be easier to see a year-over-year price change, because if in July and August last year prices moved sideways, then this year in July and August compared to last year, we could very easily see a bump just because it's comparing month to month of different years. And that could very easily give the Federal Reserve the reasoning that they need to go ahead with another rate hike. Now, to bring this thing home, let's look at the lag effects to show why I still anticipate deflation, even though that call, I understand, is very early on that, and the jury's still out. This chart from Infinitive Wealth Advisory shows two charts that seem to be highly correlated. On the blue line, we have the year-over-year change in the money supply. So let me explain that. That money supply chart we were looking at earlier, the M2, that was the total number of dollars. You can also plot the change as a percent from year to year of the money supply. Take a look at this blue line, and you can see that the growth rate of the money supply from 2013 through the end of 2019 was somewhere around this 2.5% to 7% range, meaning that every year the money supply would expand by about, let's say, 5% 3% on average. Obviously, when the money printing started, we saw the growth rate of the money supply spike, peaking out at over a 25% year-over-year change in the money supply. Since then, things have moved drastically down. The growth rate in the money supply started to fall as the Fed stopped printing money, and it's actually negative now. A negative growth rate of a money supply simply means that the money supply is shrinking. The total number of dollars is going down. It has a negative growth rate. Also keep in mind that this is the fastest the money supply has contracted and the most it has contracted by since the Great Depression. So there's that. Now take a look at the orange line that we are comparing this against. The orange line has the measurements listed on the right axis, and this is the CPI with an 18-month shift. So back here in 2013, 2014, 2015, this is not what the CPI was at that time. This is what the CPI was 18 months later. So sometimes it's important to mess around with charts and the axes and how you measure it and the time frames so that you can see things like lagging effects from the monetary supply onto the inflation rate. And it's not going to be identical because the lag effect is not going to be consistent and linear, but it matches up pretty closely, showing that about 18 months after the money supply started to spike to an unprecedented high, the rate of inflation did as well. And given where the growth rate of the money supply has gone, that would also indicate that inflation will head that direction as well. Now, it's currently July of 2023, and you all know that last year I was forecasting that by the end of Q1 of 2023, we would see inflation numbers below 3%. It's July, and we just now finally hit 3%. So I still think I'm early, but like I said, the jury's still out. Based on everything I'm looking at, recession indicators, the money supply, interest rates, credit slowing down, it looks like there is a deflationary recession on the horizon. It's just taking longer than I originally thought. Given all of this, how am I investing? Let's do a rapid fire here. In response to these low inflation numbers, gold popped. Silver really popped over 4%, and Bitcoin was flat. So as a store of value, as my savings, as my reserves, I am looking at gold and silver and Bitcoin. None of this has changed. Small allocations to high yield cash accounts like money market funds. For stocks, I'm looking primarily at commodities. I'm looking at miners. I'm looking at value stocks, hedged with long-term out-of-the-money puts. I'm also investing in hedged residential real estate right now. Low supply, sustainable demand, and highly resilient in the face of crazy interest rates. Pretty simple, pretty straightforward. Now, this is what I call my bulletproof portfolio. If you are interested in more details and instructions on execution, advanced hedging strategies, fundamental analysis for value investing during bear markets, and much more, you gotta join Heresy Financial University. This is my membership program where I put my entire training library of courses available for you. And every time I come out with a new course, I've got a new one coming out very soon on retirement accounts. Everything you need to know about how to use retirement accounts, maximize the amount that you have in retirement without even contributing any extra. Sign up for Heresy Financial University. Link is in the description below. As always, thanks so much for watching. Have a great day.